Welcome back to part two of our special two-part episode. I'm James Ridley, and as a reminder, this episode comes from a webinar we ran a little while back, Coming Home from the United States, which we're releasing as a podcast due to popular demand from listeners who wanted a chance to hear it in this format. If you haven't caught part one yet, we'd recommend going back for it. Martin Jack, one of our specialist financial planners here at Atlas Wealth Management, and myself cover the strategy and wealth side of repatriating, including timing a move, sorting your US assets, and what changes the moment you land back in Australia. This part is all about the US exit tax, presented by Joshua Ashman, CPA and Partner at the Expat Tax Professionals. If you're a US citizen or a green card holder heading home, this is the episode that answers the question a lot of people don't think to ask until it's too late. Will you actually trigger the exit tax? And if so, how much could it cost you? Same disclaimer, as always, applies. This general information only. Not personal tax advice, so please check your own situation with a qualified professional before making any decisions. All right, let's get into it. Over to Josh.
Thank you very much, James, for the introduction, and thanks everyone for joining us this morning. My name is Joshua Ashman, and I'm the Managing Director of Expat Tax Professionals. We specialize exclusively in U.S. international tax, and over the past 15 years, we've helped many foreign nationals who have lived and worked in the United States navigate the move back home. Today, I'd like to focus on one very specific topic: what Australians with U.S. green cards need to know before moving back to Australia. Many people assume that once they leave the U.S. and hand back their green cards, they are finished with the IRS. Unfortunately, this isn't always the case. There is a set of rules known as the U.S. exit tax rules that can apply when someone gives up a green card. The good news is that with proper planning, many Australians never have to pay it at all. Over to the next slide, please. The first question I ask a client isn't how much you are worth. It's actually much more fundamental than that. Does the U.S. exit tax regime apply to you at all? Before we talk about net worth, tax liability, or calculating an exit tax, we first need to determine whether you're even within the scope of these rules. If you look at the timeline a second, for Australians moving back home, this is often the most important planning point. The exit tax doesn't apply simply because you have a green card. It applies only if you're considered a long-term resident, an LTR, for U.S. tax purposes. A long-term resident is someone who has held a green card in at least 8 of the last 15 tax years. And here's where many people get tripped up. It's not 8 anniversaries. It's not 8 full calendar years. It's 8 tax years. Even if you held your green card for only one day during a calendar year, that entire year generally counts as one tax year. So years 1 through 7 are generally outside the exit tax regime. Once you move into the 8th tax year, you've crossed an important threshold. That doesn't mean you'll owe exit tax. It simply means we've now entered the regime where we need to ask the next questions. If you see in the planning note down the bottom, imagine you've accepted a role back in Sydney, you've sold your house, the kids are enrolled in school, you've booked your flights. If you only start thinking about these rules at that point, many of the planning opportunities have already disappeared. That's why we encourage Australians planning a move home to seek advice before surrendering their green cards, not afterwards. Next slide, please, James. So let's assume you've crossed that first threshold. Does that automatically mean you'll pay exit tax? Fortunately, no. There are 3 additional tests, and you only need to satisfy one of them to become what's known as a covered expatriate, or an expatriate that is subject to the exit tax. The first is the net worth. If it's over US $2 million, you satisfy this test. One thing Australians often underestimate is what counts. It isn't just your US assets, your home in Australia, investment properties, your super, your US retirement accounts, everything worldwide is included. The next is tax liability. The second test looks at your average US income tax over the previous 5 years. For 2026, that's approximately $221,000 per year, Importantly, though, that's the tax itself, not your income. Many people confuse the two. The third and final test is the certification. This is the one we see the most often. You must certify that you've complied with all of your U.S. tax obligations for the previous 5 years by filing Form 8854. If you can't make that certification, you're automatically treated as a covered expatriate, even if your net worth is well below the $2 million. This is one of the reasons we encourage clients to become fully compliant before thinking about giving up a green card. This can include taxpayers who have faithfully filed their U.S. tax returns each year, but inadvertently failed to report certain lesser-known international information returns relating to foreign companies, foreign trusts, foreign bank accounts, or certain foreign investments. This is a common issue for individuals who have used a domestic U.S.-located CPA, who may be highly experienced with U.S. taxation, but less familiar with the international reporting requirements that apply to Americans living abroad or those with foreign assets. So let's assume you are a covered expatriate. How is the exit tax actually calculated? Next slide, please. The easiest way to understand the exit tax is this. The IRS pretends you sold everything you own the day before you expatriate, even though you haven't. Imagine you own a rental property, you haven't sold it, you haven't received any money. Nevertheless, the IRS pretends you sold it yesterday. That's known as the mark-to-market regime. Fortunately, there is a generous exemption. This year, it's approximately $910,000 of built-in gain. Only appreciation above that amount becomes taxable. Now, to make this Australian specific, one planning opportunity that's particularly relevant for Australians is the basis adjustment available to long-term residents. Many Australians arrive in the U.S. already owning investment property back home. Those assets can often receive a step up in basis to their value when they first became U.S. residents. This can dramatically reduce or even eliminate the exit tax on appreciated assets when they eventually move back to Australia. But property isn't the only issue, though. For many Australians, pensions are the larger concern. Next slide, please. Retirement savings are often the most valuable asset Australians accumulate while working in the U.S. Unlike capital assets, pensions don't generally fall under the mark-to-market rules. Instead, different provisions apply. In some situations, the IRS effectively treats the pension as though it had been distributed immediately before expatriation, resulting in ordinary income tax. That creates a potential problem because when you eventually retire in Australia, Australia may tax those same pension benefits again, as Martin had described. Without planning, there is the potential for economic double taxation. Fortunately, there are important exceptions. Foreign pensions established before someone became a U.S. resident often receive much more favorable treatment. There are also elections available for certain U.S. retirement plans, such as 401ks, that can defer the tax until actual distributions are made. The important point is that pension planning should always be reviewed before surrendering one's green card. Okay, let's move to some case studies now. Let me show you a real life example. These clients were Australian citizens who had spent many years living and working in the United States. Their goal was simple: move back to Australia and surrender their green cards. The husband had accumulated significant U.S. retirement savings and without planning would have been subject to exit tax. Fortunately, they came to us before making any decisions. We developed a gifting strategy, carefully considering ownership of assets and coordinated the timing of everything. One word of caution, though, gifting is another area where it's easy to oversimplify. What seems like a straightforward transfer can create unintended tax consequences or reporting obligations in one or both jurisdictions. Make sure you obtain advice before making significant gifts across borders. In this case, though, the end result was that both spouses were able to surrender their green cards without triggering the exit tax, while also avoiding unintended gift tax consequences. A good result. Next case, please. Next slide. The second example highlights a different planning opportunity. These clients also intended to return home. In this particular case, it was to New Zealand. At first glance, everything suggested they were caught. Their combined wealth exceeded $4 million, dollars, and it appeared they had crossed the 8-year threshold. However, after reviewing the treaty position, we concluded they should properly be treated as non-U.S. residents for tax treaty purposes during the relevant year. That meant they never actually became long-term residents for exit tax purposes. In this case, we documented the position in a detailed memo, filed the appropriate treaty disclosure, and fully explained the position to the IRS. The result was that they avoided the exit tax entirely. So sometimes the biggest tax savings isn't finding another deduction. It's realizing that the tax, never applied in the first place. Okay, next slide, just in closing. So if there's one message I'd like everyone to leave with today, it is this: don't wait until you've booked the flights back to Australia. The vast majority of successful exit tax planning happens before someone gives up their green card. Once the green card has been surrendered, though, many of the planning opportunities disappear. If we have 6 months or ideally a year, we can review your timing, your pensions, your worldwide assets, treaty positions, and gifting opportunities to determine whether the exit tax applies at all, and if it does, how we can legitimately minimize or avoid it. Hopefully, this is giving you a better understanding of how these rules work, and more importantly, why early planning is so valuable. Thank you very much for your time, and I'd be delighted to answer any questions.
Beautiful. Thank you so much, Josh. There were some great insights there. We've got a number of questions that have come through, so I'm going to try and condense some of these and summarize them because there's a lot of overlap with some of them. I can see there's a question here which has been submitted by Russell, David, and Melissa, which all overlap. So I'll frame it up. This is a good question for you, Josh. I'll just read it out as it is. How are tax residency and taxation affected if I relocate back to Australia but continue working for a US employer receiving US wages, stock compensation, retirement benefits, or occasionally traveling back to the US for work?
Okay, that's a good question. Let's assume for a second that these taxpayers are no longer residents in the US. That being the case, generally income is sourced, which means the country is given the right of taxation based on where the services are performed. So again, in our scenario where perhaps they're no longer US residents, they're no longer working in the US, then technically they would be exempt from tax on the income in the US. However, I will note that the US payroll may continue to withhold taxes, both income taxes, social security taxes, maybe even state income taxes. So that's definitely something you want to look at to try to organize with your employer, with the payroll department, to perhaps adjust the amount of withholding to prevent the situation where there's a cash outlay, there's withholding taxes, and there's taxes due in Australia because that's where the work is being performed. So in a sense, you've paid tax at source, you're estimating your taxes in Australia, and then you're left with very little cash to go with. So it'd be very important to identify which country in that case will have the right of taxation, and then work with the payroll department filling out the correct withholding certificates to try to avoid a situation where there's a, even if it's not an ultimate tax, an ultimate double tax, but work out a situation where you can be in a better position to plan your cash and avoid some unnecessary withholding.
Yep. Yep. Good question. This one is, I think, probably an easy one for Josh here. When does the US exit tax apply to Australians that are on an E3 visa but have lived in the US for more than 8 years?
The good news is it wouldn't. The exit tax would not apply to someone who was in the US,
Yep.
who was a resident alien based on substantial presence, but who did not have any immigration status like long-term residency or like permanent residency.
Yeah, and that's so crucial. We often interview and do a lot of consults, discovery consults with Australians that have been in the US for a number of years, but they've only ever been on an E3 visa. So the exit tax isn't really a concern for them. It's mainly obviously permanent residency, green card, or US citizenship. That's the issues that can lead into those other tests. So that's a good one. Another question here around California and state tax residency. This is from Russell Yu. Can I remain subject to Californian state tax after moving to Australia? And what factors can determine whether I'm still a state tax resident?
Yeah, this is a good question. Again, I'll jump in with an answer.
Mm,
One, I think overriding principle, something to keep in mind is that the particular states, in this case California, are not bound by any of the treaties that are negotiated on the federal level, on the IRS/ITO level. So that means that determining whether one continues to be a resident in a particular state is very, very state specific. Each state has their rules, who's considered to be a resident. Some states it's based on physical presence. Some states it's based on a much more um, domestic type of test known as domicile. So, each case needs to be looked into. But what's clear is that as you're planning your move from, let's say in this case, California, it is important to make sure you're taking steps to disconnect yourself from California domicile because California is a domicile state. That means certain personal connections, business connections, like voter registration, car registration, memberships, et cetera. So domicile will really drive, in California's case, whether or not you're considered to be a resident. One thing that will be important, although maybe simple in a case of someone moving back to Australia, is you'll definitely need to establish domicile elsewhere before you're
mm,
able to terminate domicile in California. But if that's done properly with some proper planning, you can avoid. There are still some sources of income that will remain taxable in California. One of the examples we gave today was owning a U.S. property and renting it out. If that property is in California, that'll continue to be considered subject to tax in California. Also around equity compensation, certain instances of RSU vestings and
mm,
things of that nature can also remain clawed back, or that tail can remain with California for a while too. So very important to analyze the assets, of course. Very important to plan the exit and the termination of domicile to try to avoid California. But states like California are very aggressive. There are other states too, which a lot of people
yeah.
move to for work purposes, like Massachusetts and New York, California, et cetera. So yeah, it's a good question. It's very different than what was talked about tonight, which was much more focused on a federal level. But at the same
Mm,
time, with proper planning, can be optimized.
yep. Good question there. Another question here, might throw this one over to you, Aman, from Alice. Can Australians continue to hold and operate US brokerage accounts such as E-Trade or Fidelity after returning home? And then second part and follow-up is, when would a platform such as Interactive Brokers be preferable?
Good questions. Very, very common. I think yes and no to that answer. So can they
Mm,
continue to hold it? Yes, typically. Can they continue to operate it? Not always. So, use Fidelity as an example. Typically, they will allow you to continue to hold it, but you won't be able to continuously invest and trade on the account as a non-resident alien. So you do have to look into that, speak to the platforms that you have, your existing brokers, and determine whether or not they are actually suitable for the expat space. Interactive brokers, yep, they could be a good option there. One of the main ones that I think a lot of our clients use, and we've seen some good success through, is Charles Schwab International.
mhm,
Just that they're a lot more flexible than someone like Merrill Lynch or E-Trade and Fidelity and so on. So yes and no to that. There are some platforms that will accept it. There are some that will restrict it. I haven't really come across any that have just blatantly said no if you've already got funds there.
mm.
But yeah, definitely look into it.
Yeah, I think Interactive Brokers as well, it's not the best user experience.
Mm.
We've had a number of clients that have held assets on there, and when they come back, the customer support they get from Interactive Brokers, just the headquarters, is usually pretty awful, to be honest. It just becomes a good tool to hold. Maybe doing some currency transfers can be okay as well, but there are certainly some restrictions that can be applied to it. That's for certain. I think also if you're coming back and you're going to continue holding some sort of assets on these kind of accounts, I've seen Josh mention it before, but probably making sure you're submitting things like a W8 bend form and making sure they're,
Mm.
treating you as a non-resident alien. And I think that probably extends to withholding taxes. Is that right, Josh?
Yeah, that will ensure that they're going to apply the withholding taxes properly, which will negate an obligation to continue to file a U.S. return. If a
Mm.
non-resident has investment income, let's say dividends or even capital gains and some interest, if the withholding is done properly in accordance with the U.S.-Australian tax treaty in this case, then actually there is no obligation to continue to file a tax return solely to report that investment income. If, however, they're either not withholding, which is improper, or they're withholding too much. The U.S.
Yep.
Standard withholding rate is 30%. But
Mm.
for example, on dividends under the U.S.-Australian tax treaty, it's only 15%. So if they're withholding 30%, then if you want to get back the withholding, then you'll have to file a tax return to make that claim. So by submitting a W-8BEN, confirming your residency as an Australian, the financial institution should apply the correct withholding rate, dividend 15%, zero on capital gain, zero on interest, in which case, you're good to go. No need to file, no need to claim, no need to report.
Yep.
So that's something I think that those that are leaving the U.S. tax net or moving abroad, they like to stop filing. They don't want to continue to report to the IRS. So this is the way to do it, to make sure you have the withholding certificates up to date properly.
Yeah.
Yes,
I agree.
I agree.
Keep it
I
simple.
think I might add one comment there is making sure that the platform accepts it. Sometimes
Yes.
platforms do not accept it at all, and it's simply because they don't really gain anything from it. If they stuff it up, then it's on them, and they're going to cop it from the IRS. So working with a team and working with a platform that is more expat friendly and confirm and apply the correct withholding tax is really important. And that comes down to how you fill out that W8 BEN as well. So definitely do that and work with someone, a platform that is more expat friendly.
That's a good point.
Yep. Good question there. We've got two questions here, which are sort of looking at from, I guess, either sides of a different lens. First question from Michael Corbett. Thank you for this one. How does Australia's deemed acquisition cost-based step-up work when becoming an Australian tax resident? And does it apply to shares, ETFs, and cryptocurrencies? I'll let you handle that one, Martin, and then I'll send the follow-up question to Josh. I'll repeat it after. So over to you, Martin.
Yes, well, it does apply to shares, ETFs, managed funds. Basically, deemed acquisition, the day that you become a tax resident, becomes the new floor or the new cost base for those shares. So as I mentioned, it's a bit of a double-edged sword. So if you've got a large unrealized capital gain, that's fantastic. But if you've got a capital loss or some losses that you haven't yet harvested, then it might be time to do that beforehand because you're not going to get that benefit here in Australia. That basically becomes your new floor, and then gains from that point onwards, if you sold them down, would be taxable here in Australia. So applies on your worldwide assets. The only sort of, I suppose, caveats I would apply to that, it would be anything held inside of something that would fall under a foreign investment trust. So, the Roth accounts, or potentially if you have it held through a living trust as an example. So that just requires a bit of extra attention.
Yep, good one there. So on the other side of this question is pretty much the same question, but does the US have a corresponding tax event? So does the US have a deemed acquisition type of event when becoming a US tax resident? So looking at entering the US system, I guess.
It's a good question, and it is one of the areas that the US and Australia do not align. There are several, and this would be one of them. There is no automatic deemed acquisition or rebase of assets when becoming a U.S. tax resident. There are ways to accomplish that, okay? But it's definitely it's not the same as Australia in that it's not automatic just because residency is triggered.
Yep. Question here around selling a former US primary residence, which turned into investment property. So good question, Oliver. What are the Australian and US tax implications of selling a former principal residence that became an investment property before returning to Australia? So I'll look at this from the Australian side. So unpacking that question, it sounds like you had a main residence in the United States, which you then turned into an investment property, and then you returned back to Australia and then maybe sold it. So if you're an Australian tax resident at that point of time, you can actually use the main residence exemption. A couple of caveats to that is that you do not have another property in Australia, which is your main residence previously. If you don't own any other assets, property assets in Australia, then you can use this 6-year temporary relief rule where you can own essentially a former main residence and rent it out for up to 6 years, and you do not accumulate any capital gains tax on that asset. So if you're selling within that window of 6 years of when you first rented it out, because the ATO would look at that, then you're completely fine. It actually would be a tax-free transaction. And that is just using the main residence exemption from the Australian side. We often have sometimes this scenario play out where a client might be repatriating, but it's taking them longer to sell their former US main residence. So they're back in Australia, but it's taking for some reason 6 months to offload their former US main residence, but they haven't actually purchased or established a new main residence in Australia. So in that instance, they're just using the main residence exemption. That's fine. You can also, within the legislation on the ATO side, you can technically have two main residences for up to 6 months, technically, but you can't really game that. You can't sort of play with the rules there. You just need to be mindful of that. That's how it'd be treated on the Australian side. I'll then kick it over to Josh, just unpack the US side.
Yeah, on the US side, it's a little bit different. It's that 2 out of 5 year that I think either James or Martin had mentioned during the presentation.
Yep.
The investment property can still be considered a principal residence and eligible for the $250,000 exclusion, as long as that the ownership and use of the property has been met by the taxpayer for 2 out of the previous 5 years. So that's the window. That's required to sell the property within in order to be eligible at all for the exclusion. One thing I will point out, though, is that generally during the period of investment, the period of rental, you're going to claim a depreciation as an expense, for example. That's one of the ways that you reduce your tax on the rental is you have the gross income and then you have your expenses, including depreciation. So that depreciation is a recovery of the original investment cost of the property at about 3.6% a year. So however much depreciation had been claimed or even eligible to be claimed during the period of investment or the period of rental, that will be recaptured and taxed, despite the fact that the capital gain can still be offset, assuming you qualify up to that $250,000 exclusion amount. You'd still have to pay tax on this depreciation recapture, which is just the IRS's way of tempering the overall benefit of the depreciation, which gave you a ordinary income deduction. They require you to recapture that when you sell. So a little bit technical and nuanced. So I guess just to summarize in a nutshell, as long as you meet the 2 out of 5 years, you can claim an exclusion on the capital gain. However, the depreciation will be recaptured. So there could be still some US tax to pay.
One there. Another question here. We've got about 3 questions which are sort of along the same line. So I'll see if I can paraphrase and consolidate these. So I appreciate these, Alice, Tim, and Mark. Can I continue to hold US bank accounts and credit cards? And is there any banks that you would suggest that are expat friendly once we have come back to Australia? So expat friendly US banks. So good question. I mean, Martin, what are your thoughts on this one?
I mean, you can try. I don't think they generally like it if you're a non-resident alien, but it will take a while for them to kick it off. You should probably try to at least keep one account active. I couldn't point you to one preference. It's really a hit and a miss, at least from my client's experience. But, you know, if you have a 401k or you have Social Security that you're drawing down or even a US brokerage account, typically you need to have a USD account to actually receive those funds into. So we have come across issues in the past where someone has lived in the US 20 years ago, they're back in Australia, then they've become eligible for Social Security after meeting full-time retirement or want to draw down from a 401k. and they don't have a local bank account, no bank over there is going to allow you to open one as not a US permanent resident or US resident, tax resident without a social security number. So they have this issue where they have to sort of get a check mailed to them. But there is a solution, and I'll give you that one for free for all the listeners. It's a bit of a using a Wise currency account because they have actual branches in the US. You can use that, and because the account name operates under your actual name instead of Wise, that means that usually that's accepted from brokers, from 401k providers, and even Social Security to actually receive those funds in US dollars, and then you can move it across. So I don't have a specific recommendation on which bank, but Wise is maybe a good alternative solution, and just check before you go, I suppose.
Yep. Yep. Question here from Amir, just about US Social Security. How are US Social Security benefits treated for Australians who retire in Australia after working in the United States? So that was a good one that I guess on the Australian side, I'll answer this one, and I might give it to Josh on how it might be taxed in the US. But on the Australian side, this is the great thing about our treaty, the double taxation agreement between the United States and Australia. It's not actually taxable in Australia. You don't need to report it on your Australian tax return. It's probably one of the good things about our treaty, to be honest. So not reportable. We've got a number of clients receiving US Social Security as a general income supplement to their overall retirement. But yes, not taxable on the Australian side. Josh, how would this be taxed on the US side if they're back in Australia and no longer living in the US?
Yeah, it is still taxed. It's taxed at source. There's a withholding tax that's applied. It works out to 25.5%. It's that 30% standard US withholding on 85% of the benefit. So yes, while there's a benefit on the Australian side under the treaty, the US does retain the right of taxation, and the Social Security Administration will take 25.5%.
There you go.
I might add,
Cool.
might add just one more point to that on the Australian side is, remember that counts as income if you are looking at age pension tests. So it will count towards that as well. So just bear that in mind. Just because it's tax-free doesn't relieve you of everything, assuming that that's what you're going for.
Yep. Go on. Another question here. I'm not sure if we can answer this one from Paula. It's around US Medicare eligibility. Can former US residents continue Medicare coverage and access US healthcare services while living in Australia and periodically visiting the United States? I'm not sure if we've got the brains trust for that question. Any thoughts?
Yeah,
Not
it's
for myself. I don't know,
not my
Josh.
area of
Yeah.
expertise with the Medicare. I think it's still eligible, but probably
Yep.
best to speak to someone that specializes in that.
Yeah, we love throwing a curly one to the brains trust. That's a good one, Paula. We'll try and stay in our lanes. A good one here from Alice, centering around IRA accounts. So should Australians generally leave traditional IRA accounts invested until retirement? And are there circumstances where alternative strategies should be considered with withdrawing? So I think Martin sort of addressed this a little bit, but Martin, what were your thoughts about whether they should take it when they leave or whether they should keep it invested until retirement? What's your take?
The famous response is it depends, because it really does. It depends on your personal circumstances. There's pros and cons for each. As an example, if it's a low account balance and you're younger than the age of 59 and a half, sometimes it's worth copping the extra 10% penalty tax that you pay and then using that extra surplus to fuel and fund a different strategy back in Australia, whether that's to help you get on the property market, that's to manage your cash flow, pay down debt, or potentially add it to your superannuation where you pay 15% tax going in, but then you get to claim that contribution as a tax deduction outside of super. So if you're taxed at 47%, you could potentially be saving 32% Australian tax just by wearing an extra 10% in the US. For larger account balances, though, I mean, yeah, usually it makes the most sense to delay it until you're over the age of 59 and a half, drip feed it out, manage both sides of the tax regimes there and the tax systems, submit the W-8 then, get all those boxes ticked. There's also things you can do before you come back to Australia if that's the plan that you've done, to alleviate some of the future Australian tax considerations. So then we're mainly dealing with the US side.
Yep. Yep, good one. I only got a few more questions, so I thought I'd just jump over the slide in the event you guys need to reach out for some advice, and I'll be sharing Expat Tax Professionals website very soon, so you can jump on there also. But that was a good question, Alice. One from Anonymous, so not putting their name to the question, that's probably wise. What ongoing US tax filing obligations apply to dual Australian US citizens who permanently reside in Australia? Good one for you, Josh.
Yeah, unfortunately, a lot of ongoing compliance is required, and things get pretty complex once you are in this international arena. With respect to Australia in particular, the topic of today's discussion, I would say that there are many areas where the systems align. There are many areas, unfortunately, where they don't align. So things around PTY limited companies were talked about today. Certain investments in non-US ETFs, mutual funds, can also trigger enormous, compliance obligations and some onerous results. Foreign trusts for sure, Australian discretionary trust, family trust. So yes, it's a cleaner break when you have either a resident alien that's leaving Australia or even a green card holder who's planning to properly exit the U.S. tax system, avoiding exit tax. The American citizen, the dual U.S. Australian citizen, will continue to have this obligation and will really need to navigate things properly to avoid some mishaps and potentially double taxation inefficiencies. So I would very much recommend that that person anonymous to seek a good professional help from someone who understands both sides of the system and can coordinate that properly.
Yeah, absolutely. We'll close it out with two more questions. This one we might have actually just addressed, but I'll just read it out from David. What happens to existing 401k accounts after returning to Australia? And what should be considered before making withdrawals? So Martin, might get you to tackle that one first.
Yeah, sure. I mean, reiterating a lot of the points that we've already made today. So what happens, sorry, was it before or after, James? Sorry, I missed that.
Yeah, what happens to existing 401k accounts after returning to Australia?
After, yeah. Well, the business as usual, they will just continue to tick along. As I mentioned, some platforms are more expat friendly than others, so it can pay to move on to a more expat specific type of platform or expat friendly one. If you're making withdrawals, you pay taxes in the US, you submit the W-8 BAN. Ideally, you can get that withholding brought right down. In Australia, corpus, earnings, Section 99B treatment applies here. So understanding if I draw out X amount from my 401k, how much am I paying here in Australia? Can I reduce that in any manner? And I suppose, going back to Alice's question as well, what bank accounts are suitable? Consider keeping a US bank account or maybe using that Wise account as a bit of a trick there. But yeah, reiterating a lot of the points that we've already made today.
Yep. Yeah, and just the last question here, mainly one for Josh. How are RSUs and equity compensation taxed when I return back to Australia but leave them in the US?
Yeah, so if they're fully vested and the RSUs have already been released and you're holding the RSUs as stock, then we'll talk federal. Again, each state might have a different way of looking at it, but just from a federal tax level, at that point, your any additional appreciation will be considered capital gain. That would generally be exempt from tax in the U.S. if we're talking about a non-resident who spends less than 183 days in the U.S. There's some conditions there, but let's talk high level. Capital gains earned on U.S. securities by a non-resident living outside of the U.S. is going to be exempt. So an RSU that's fully vested, those will generally be exempt from tax in the U.S. If vesting has continued or it continues, then and the compensation component of the RSU has not yet been taxed, upon vesting, there may be a portion that's still subject to tax in the U.S. If, for example, half of it had vested while you were a U.S. resident, half of it had vested when you were non-U.S. resident, and then the vesting is completed, then 50% in that example would still be considered subject to tax in the U.S. Upon vesting. And that means that even if you're a non-resident at that time, you would be subject to tax in the U.S. You need to file a non-resident tax return. It's likely that the employer will continue to issue a W-2 for that compensation amount. They may even withhold tax on that compensation amount, which is correct. And then you would file a tax return, making sure to include only the U.S. portion of the vesting. That's generally how it works with RSUs.
Yep. Yep. Good one there. Final comment from Anonymous. Will you be doing more webinars like this, which involves and is specifically tailored for dual citizens that are returning back to Australia? So yes, we will be. We've got Josh on. We've put him in the hot seat. So we are going to get Josh back on another time over the coming months, and we'll try and tailor another one specific around this. Not necessarily exit tax, but maybe just more around US taxes, dual citizens, those sort of considerations, especially as the tax year winds out for the US side once more. That is it from all of us today. Joshua, Martin, really appreciate your time this morning to run through what's been obviously a pretty technical topic to unpack. So if something has resonated with you today, please make sure you reach out to Expat Tax Professionals or Atlas Wealth. In the meantime, guys, really appreciate your time. And that's a wrap on our two-part repatriation special. Between part 1 and part 2, we've covered the full picture, from timing a move and handling your US assets through to whether the exit tax actually applies to you, and what the real-world case studies tell us about planning around it properly. If there's one thing to take away from both episodes, it's this. The order in which you act matters just as much as the actions themselves. Get the sequencing right before you leave, not after you land, and you can avoid a lot of unnecessary tax on both sides of the Pacific. Thanks again for all the requests to get this one out as a podcast. It's generally great to hear what content resonates, so don't be shy about letting us know what else you'd like to hear from us. If you're planning a move home from the United States and want to map out your own repatriation plan, reach out to the team at Atlas. You'll find the details in the show notes. Thanks for listening, and we'll catch you on the next episode of Expat Chat.